Hello and welcome to Switzer Investing. I'm Peter Switzer, and on this show we test out the recent bounce for tech stocks Altium and Appen. Is this the start of something good and positive, or is it a false dawn? We asked Julia Lee of Berman Invest for her views, and we get Mike Gable of Fairmont Equities to run his chart eye over the latest share price movements of these two stocks and some other stocks we're interested in. And then Paul Rickard looks at the demerger of Woolworths with Endeavour Drinks. That includes Dan Murphy's and BWS. It's going to be a really big demerger coming up. And the question is, should you buy Woolworths now and try and get the benefit of the demerger, or should you wait? We'll ask Paul about that. So that's a really important demerger coming up. That's the show. So let's kick off with Julia Lee. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Hi, Julia Lee.
Hi, Pete. How are you doing?
Very good. Now, Julia, I always like to throw to you some of the stuff we've been looking at over time, and later on the show, I'm going to talk to Mike Gable about what the charts are saying about Appen and Altium. We talked about it a couple of weeks ago. They have gone for a bit of a rise, which, and I want to sort of test it out. Is this the start of something good, or is it just a sort of a sideways movement or whatever? So what's your take on both those companies at this point in time?
I think a couple of weeks ago I was saying, I like Altium as a COVID recovery story, but I'm a little bit more wary around Appen. And that's because I think its business model is shifting, where we are seeing a lot of the big techs bringing some of the AI in-house, which might affect the business model. So I'm still not sure with Appen, but I do like Altium. And I think since we spoke, it's rallied from around about $24, $25 to be above $28. So that's been a nice move up. But this one I'd place in the COVID recovery story basket, the printed electric circuit boards. Yeah. Whereas Appen, I think we are seeing a shift in terms of what the landscape of its business looks like. So yeah, I'd be a bit more wary on Appen at the moment. Yeah.
Julia, I interviewed for my podcast a guy called Matthew Mikhailovich, who wrote a book on the rise of artificial intelligence. And he kind of made the same points that you made about Appen. I asked him about Appen, which he said was a great innovative company. But one thing he did mention was that with all technology, like we remember when mobile phones were like big bricks, and now they've become so small, but they've got more computer power than NASA had when they put their man on the moon. All that sort of thing staggers me. He made the point that artificial intelligence, like all technology, will become more accessible to medium-sized businesses and ultimately small businesses. I made the point, I asked the question, would that benefit a company like Appen when they're less dependent on really big companies who use their services? And he kind of thought, well, probably that would be the case. What would you think?
Yeah, I think Appen's just got to change up its business model a little bit. I think we have seen a few changes in terms of how Apple collects its data as well. And if you have a look at some of the Facebook algorithms which are happening at the moment, I think it's shifted. So Facebook might be targeting some of their users through their own algorithms. And I guess what makes me a little bit cautious about Appen at the moment is that it has been a human intensive model. It has a huge, massive workforce. And when they came out and they kept to their guidance, but they said they were cutting costs through cutting off some of their workforce, that's what made me a little bit wary, because for me, growth in Appen comes sort of hand in hand with the growth in its workforce. So I guess I'm just a little bit wary at the moment until I get a bit more confidence around its business model. Whereas Altium really, I think, is more a COVID recovery story.
Okay, right. Let's go to the next one. And we've been asked some questions from viewers. Server Stream, what's your view on that?
Yeah, look, ServiceStream has come under a lot of pressure, and I guess its share price reflects that at the moment, the uncertainty and the margin compression that we are seeing in terms of the business. Now, ServiceStream is responsible for the rollout of NBN, and so it's really all about the lack of NBN take-up that we're seeing at the moment. Upside will come if we get more work through NBN upgrades, but looking at where the share price is at the moment, I guess it is worth putting a little bit of money in it and then putting more money in as you gain confidence in the business model, because there is quite a bit of value in terms of ServiceStream's share price where it stands at the moment. And look, going and looking at a longer term picture of ServiceStream, it has quite a good track record. So unfortunately, it's been dragged down by some of the weakness in NBN at the moment. I'd also be a little bit cautious. There is some industrial action around the union and trying to bypass some of the prime contractors to NBN like ServiceStream, which is a key risk. But given how much the share price has fallen, putting a little bit of money in ServiceStream at these levels, I don't think would be too bad a move. But of course, it is an extremely high risk proposition at this stage. So I'm looking at ServiceStream. It has moved down up from the bottom of 83 cents. It's up at about 98 cents at the moment. And you probably need some more good news coming through from NBN to kick it above that $1 mark.
Okay, now a company that copped it last week, Costa Group, and I know at various stages of your changing mind on investments, you've liked Costa Group and you haven't liked Costa Group. What's your view, given the fact that the market has really given it a clobbering?
Yes, we don't own Costa Group, but having a look at where Costa Group is at the moment, and when you do see big announcements like this, the first thing I ask myself is it permanent or structural, or is it temporary? And I think a lot of the problems that Costa Group flagged in the first half are more temporary in nature rather than structural. So if you're a medium to long-term investor, these levels are looking relatively attractive to start adding Costa Group to the portfolio. Look, some of the problems they had in the first half, they had hail affecting their grapes, which of course is a once-off. We saw warmer weather in March, which impacted on mushroom demand. We're going into the colder months, so that's likely to reverse, and we're likely to see stronger demand coming through for mushrooms, and we're likely to see a higher yield for its citrus business as well. We know that there's been a lack of short-term workers coming into Australia, like travellers, which has been impacting, especially in terms of the blueberry space. But once again, that's a COVID-related problem, and that's expected to normalise as we do see normalisation post-COVID-19. So look, these problems aren't, I think, structural in nature, but more temporary, which means that there is an investment case there for a medium to longer term investor to start adding Costa Group.
Okay. Now, one that I know you're not necessarily a great follower of, Baby Bunting. What do you think?
Yeah, I have liked Baby Bunting in the past. At this point in time, I'm undecided on whether we're going to see a baby boom or a baby bust in Australia. So I'm sitting on the fence line here. I wish I had a view on whether we are going to see a baby boom post-COVID-19 or a bust. But if we have a look at some of the developed economies around the world and economies around the world, we're seeing a bit of a baby bust, whether we look at Europe or China. So look, I am a little bit cautious of Baby Bunting at these levels, although I know there are a lot of analysts which are positive on Baby Bunting because they expect a baby boom. But I'm sitting on the fence. I don't know whether there's a baby boom or bust. So I'm not forming a view on Baby Bunting.
Well, I've got two relatable stories. One is I do remember outing you on my Sky Business program when I announced to everybody that you were pregnant twice, even before your family knew, which of course got me in a lot of trouble. But I think at the time we're probably talking about Baby Bunting, like I see in no segue. But also, I would have thought because of that period where people were locked up at home and not at work, that could have actually encouraged the development of more Australian babies.
I don't disagree with you there, Pete, but what we're probably going to see less of is, people, getting pregnant by meeting someone down at the pub or through like a music festival or event.
So there's pluses and negatives.
People who are wanting to have babies are probably still going to have babies. It's just the incremental margins. How do you meet someone when you're in lockdown and
Yeah, that's a good point.
drinking
But I also,
someone else.
well, the thing is this, I figured for the first 6 months of stay at home, you exhausted all the Netflix and Stan programs you could find. But after that, that would have been good for procreation. So I'm figuring babies will show up in 2022 as opposed to 2021. But that's just
I don't think it's a problem of with married couples having babies. I think it's like single people trying to find someone to have a baby with, and that's where my question mark is, whether lockdowns sort of.
I'm so old-fashioned. I'm not thinking about people having babies out of wedlock. You're
I think
such
during
a modern young
events,
woman.
things like the Olympics, there tends to be a baby spike. When people mingle, that's when things happen.
Okay, great stuff, Julia. We won't go any further. Thanks for joining us in the program.
Thanks, Pete.
Well, a few weeks ago, I wrote a story about AAA stocks. Now, of course, they weren't really AAA, but I like using that idea of 3A stocks with their names starting with A. And Appen, Altium and A2 with three really good quality companies that have been beaten up in recent times. And I posed the question, when will they start to rise? And since then, we have seen Altium and Appen do reasonably well. A2 is still struggling to take off, though I think it will happen eventually in time. But I thought I'd like to get Mike Gable to test out what he's seen so far. Are the rises convincing enough to believe the worst is behind them and maybe there's some good times ahead? Mike, thanks for coming on the program.
Thanks, Peter.
So we remember talking about this. You got Appen on the APX, that's their ticker code, on screen. What have you seen so far and what's your view in relation to what you're seeing?
So I guess the first point which is clear is that it is still in the downtrend. So what we need to do is find signs that that downtrend is over. So usually what happens is when a downtrend ends, a stock will often base, so it might head sideways for a while before heading higher. But sometimes it can turn around and get straight back into an uptrend. So unfortunately at the moment it is still in a downtrend. When I look at the specific price action, so this is a daily chart, so we've got daily candles. We could see that day at the start of, at the beginning of May, where it dropped quite substantially, but it hasn't gotten worse since then. So I mean that's a positive. We just need to see it basically break this downtrend. So
that blue line you got there, if the current selling was above that line, will that make you feel more positive?
Yeah, so that blue line up until it fell under it, there seemed to be very good support around $16. So, and that also corresponds to the previous high. So if we're looking at a trend, so a stock heading down, we have lower highs, lower lows. So ideally, we need to see that prior low that prior high get taken out, which is represented by that blue line. It doesn't mean it'll continue higher after that, but that'll be, I guess, the first sort of major sign that proper buying's coming in, because
that's around $16 or so.
Yep. So around $16, there's been a lot of buying previously. So what you'll find is when the share price gets close to that, there'll be quite a bit of selling. So people looking to get out. So if that can get overcome, that means
hopeless, are they? Always self-interest.
Yeah, exactly. Looking out for themselves. So look, if it can overcome that level, it's the first sign that there is some decent buying. It may then drift sideways for a few months, but for anyone watching Appen, I think if it can trade above $16, that's the first sign that it may well be finding the low. Okay,
well that's a good piece of advice for people. Not advice.
General advice.
General advice, but also astute observation from a chartist. Okay, let's go to the next one, and that is Altium.
So it's a similar situation here. We need that previous high point to get overtaken.
Because it's $30 in this case.
It's $30. So again, as we could see, because this is in a downtrend, every time it gets close to the previous peak, investors step in and dump it. So it needs to overcome $30. Now it is getting close, but what I've
It's a more convincing bounce than Appen you're kind of implying at this stage.
But unfortunately, it still looks quite unsustainable. So what I mean by that is the big sell-off at the start of May was quite sharp, and then the bounce has also been quite sharp. And these sorts of V-shaped bounces, it's very unusual for the stock to then continue to kick on. It needs to use up a bit more time. And what I mean by that is, again, we need to see a little bit more sideways action out of Altium. So, if you're looking at Altium at $28, there will be clear resistance at $30. The previous low was at 24. So what you've got is potentially $2 upside, but potentially $4 downside for it to get back to that previous low where there might be some buying. So at the moment, the risk reward is very poor to be chasing Altium here.
Yeah.
But again, $30, if it can get above that, that's the first good sign that something's up. So not too dissimilar to when we looked at the chart for Megaport a few months ago. We're looking for those previous peaks to get overtaken. And then when we spoke a few weeks ago, we noticed that did happen, and that was the first sign that good buying would step in, and Megaport's actually been doing pretty well the last few weeks. So I think we just need to be patient with Altium. It'll happen eventually, but if you could see those previous peaks get taken out, and that's the first sign that...
Reporting season should be interesting for both those companies.
Yeah. Well, we also had Appen, I think from memory, they reiterated their previous guidance, and the market was looking for that as well.
Yeah.
So
and I think
a little bit more information.
Cost cutting as well.
Yeah, a little bit more information from these companies would help.
Okay. Okay. So these are some questions that came in from our Boom Doom Zoom show for the Switzer report subscribers. And Baby Bunting is an interesting company. Baby Bunting's an interesting co. Sorry. Yeah. Okay. And it's looking pretty positive, but you're the person who tells me whether I'm seeing the right thing.
Well, at a basic level, as we could see, this chart's the opposite of the prior two. It's in an uptrend, so that's what you want. You want to buy something that will hopefully be worth something more in the future. So, Baby Bunting, we've still got a very nice uptrend. I don't see any danger signs with this. The squiggly blue line here is the 100-day exponential moving average. Now, the reason why I chose that is basically because it just seems to fit really well.
It does.
On the way up, Baby Bunting, it seems every time it gets down to that 100-day moving average, it seems to bounce off it very nicely. So
we should say to people, some people watch this and probably don't know what we're talking about. So when we say 100-day moving average, the 100-day moving average of the stock price.
Yep. Yeah, exactly.
Yeah. So some people wouldn't really understand, but the significance is it's actually giving you an idea of, in a sense, what's going on with the stock price over 100 days.
Yeah, that's right. And of course, it is backwards looking. We're looking at the prior 100 days of share price action. But if a stock is above that, then
it's feeling better,
it's got that positive momentum.
Yeah.
So in the case of Baby Bunting here, look, I think the uptrend will continue. I'd be happy to hold it if I was in it. If I was looking for an entry point, I'd prefer to get it closer to that 100-day moving average line. So again, if you're buying it just above $6, if Baby Bunting was to head back towards that 100-day moving average line, you'll be losing about 40 cents. And as long as it bounces off that, well, I guess that's fine. But you just never know; it could break under it. So I'd prefer to wait for it to get back to the 100-day moving average again. It seems to bounce off it every now and then when it turns higher, that would be the better entry point. But here it's fine as a hold.
Okay, and another company called ServiceStream. Do you know much about the company, Mike?
Oh, look, I know a little bit about it. I mean, enough probably to stay away for the time being.
It's kind of in the telco space, isn't it?
Yes, and I think they've had, sort of visibility around their earnings is a big issue because of the, you expect them to be able to pick up a lot of these, I think 5G and NBN contracts, and look, not one that I've followed too closely. But it does seem as though it has a few uncertainties there.
And the chart's not looking fantastic.
And exactly. So you've got that as well. So I think this is traded as high as $3, and at the moment it's under $1. So a massive destroyer of capital, unfortunately. Again, as we could see, downtrend in place. What I've got on this chart is the volume at the bottom. So those bars indicate volume traded on a particular day. Now, if we have a look at the middle of the screen, that big spike in volume in December last year corresponded with that big drop in the share price. And then the next time we had a big spike in volume, it was at the end of February again, big drop in the share price. So
it coincides more with selling than buying.
Exactly.
What about
However,
the last one, Mike?
So this is what's interesting. So the last spike in volume occurred on a day where the share price actually went up. So potentially a positive.
Okay, so it's worth watching, but at this point in time, you're not sending out your wife and kids to buy it.
Exactly. So again, I'd prefer to see the downtrend get broken. But what that spike of volume is telling us is that it may well be beginning that process. So we might find if we look back 3 months from now, it's still around these levels, but it's built a bit of a base.
Yeah.
Too early to buy, but yeah, that spike in volume is
So it's
quite
not a company we should necessarily wipe off the board because it could have some potential. So it's in the right space. 5G is a future space, and telcos have potential. All right, mate. Now you always bring one of your favourites along, the one that's grabbing your eyes. This one's Wesfarmers.
Yep.
Tell us why.
Oh look, I mean, well, firstly you look at the chart. It's in an uptrend.
Loop,
So
the loop on the way up.
It's doing the right thing. It's in an uptrend. I mean, we still like cyclical stocks, and Wesfarmers is cyclical via Bunnings. Now, what's interesting here is that even though it looks like it's come a long way, again, I think this one will continue to head higher. So I've put some interesting shapes here on the.
I've never seen you do this
chart.
before.
Now, this pattern is known as a cup and handle pattern.
Wow.
So
and it does look like a cup with a handle. You're right.
Some of these formations have funny names for you to remember them, but there is logic behind what it's doing here. So if we have a look at the Wesfarmers share price in February, it peaked around $56, came back to 50, went all the way back up to 56 in April, and then it was sold off from that resistance level. Now, what's interesting over the last few weeks is that instead of continuing to fall because it got close to that $56 level, it's actually held in there. So that second loop on the right-hand side, the little handle of the cup, is indicating that despite the selling pressure, it's holding in there pretty well. And in my opinion, it's just a matter of time until it pushes past $56, probably in the next few days, and then it will continue that uptrend. So
and clearly, if the second loop was deeper than the first, it'd be a bad sign. It'd be a sign that people are actually getting out rather than getting in. But that there says that there's not a real fear when the stock gets around $54. They want to buy it.
There's been some very good buying. So whoever's been selling the stock, I think they're almost finished with their selling, just looking at the way it's trading. I mean, I've been happy to start picking up some more Wesfarmers last week, but if you're a little bit more conservative, if you wait for a break above 56, then I don't think it'll be long until this thing's trading above 60.
Well done. That's Mike Gable from Fairmont Equities. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Joining me now is my colleague at the Switzer Report, Paul Rickard, and he's actually looked into the upcoming demerger of Woolworths and Endeavour Drinks. And I guess most of us want to know whether you need to buy Woolworths to get access to a really big bargain in Endeavour Drinks. But we'll get to that in a moment. Paul, what's the history of demergers like this?
Yeah, demergers generally, Peter, have done very well. And the theory goes that, a lot of organisations within big organisations, they're pretty constrained, they're capital constrained. You have to go to head office to sort of buy the stapler or buy, any sort of minor investment. And so the idea with demergers is you sort of cut the sort of company loose, or the
umbilical cord,
the peripheral activity loose, give them a new management team, a bit of capital, separate balance sheet, new board. and off they go. And historically, you know, demergers overall have done pretty well. So some really good examples of companies like you were talking about South 32 a minute off air, Treasury Wine Estates was a demerger.
Coles and Wesfarmers?
Coles came out of Wesfarmers, and so overall they've done pretty well. You know, BlueScope was another case of a good demerger. There've been a couple of duds. You know,
what's the best stud?
Well, the best stud was what called One Steel that became Arium, and that was the steelworks down in Whyalla, which is, again has still got its future up in the air. Shareholders now, Arium ended up with nothing because it went broke. Another one that hasn't done quite so well is now what's called Virgin Money UK, which came out of, that was original, the National Australia Bank spin-off of its Clydesdale and Yorkshire banks.
Great name, Clydesdale and Yorkshire banks.
Which were very traditional banks, and then they bought Virgin Money in the UK and put it together. But even so, all these years ago, almost a decade, the original spin-off price was about $4, and that's about where Virgin Money is trading today. So look, they're not necessarily no-brainers, but look, they do pretty well, and they have a pretty interesting trading history, Peter, too, that generally the demerger does it pretty tough in the market for the first few months. For that, at least trying to analyse, you know, what's the history.
The reason for it,
is that, you know, up front, you know, people suddenly get shares in this new company, and there are always people who want to cash out, right? It's a way to realise some money.
And on that point, Paul, before you go to the next part of your answer, when you're holding Woolworths shares, when you add the value of the new ones, do they tend to initially go up? Are you seem to be holding more value because of it?
Generally the sum of the theory is the sum of the parts will be greater than the whole, right?
Okay,
So that's one of the reasons Woolworths shares has gone up in value coming in the demerger period. I'll get back to that, but the history of is that when they first list and you suddenly have, you know, the new company and the old company and the share prices, you add them together, it's usually a little bit more than the whole is more than the sum of the two parts is more than the whole before.
Well said, Paul.
Right? Yeah, it took a while to get through.
Yeah.
But the demerged company, if I just focus on that for a moment, it sort of creates a whole lot of people who suddenly say, look, I don't really want shares in that company. And so they become sellers.
And this is going to be a booze company as well.
And a booze company with all the issues around poker machine licenses.
Yeah, that's it.
And so there's probably going to be quite a lot of selling on the market. And also, just because you put a share on the market doesn't mean anyone has to buy it. So you've got to attract new investors into the company. And often the fund managers just take a little while to get their act together. So typically they come on the market, they actually have quite a bit of selling pressure for the first 4 to 6 weeks, sort of finds a bottom, and then a few fund managers come in and then
they see value.
They see value, and as managers, you know, you've got a new management team, a new board, and after 3 to 6 months they're sort of starting to make things happen, and then typically they do pretty well. So when I say demergers do well, it's sort of more like over 12 to 18 months, but normally there's a bit of softness up front.
Okay, so I guess the bottom line then is, we'll probably, look, I know with the story you've written in the Switzer report, you cover all the things that someone would want to know if they actually currently hold Woolworths shares. But I guess the bottom line for many people watching this is, you know, do we need to get in before they demerger, or is you kind of recommending that they wait?
Yeah, I'm probably sort of thinking now it's a bit too late, Peter. I think it's one of the reasons, and we have said that. I've said that I've had a buy on Woolworths for some time, so I've said one of the reasons it was going to go up was because of this demerger, right?
Yeah, and people were rushing in to try and get it.
I don't know if we can, we're just looking at a chart here, but I don't know whether that chart's on the screen, Peter, but Woolworths has done pretty well. If you go back the last, it's outperformed Coles comprehensively over the last 2 or 3 months.
Yeah.
And I put that down, you know, at least one of the reasons due to the demerger coming to fruition. So it's almost near its 52-week high. So it's done pretty well. And I think that's partly the demerger coming in. So what do you do now? Well, we're sort of 3 weeks out. You have until the 23rd of June if you do want to participate. I think Woolworths is going to stay well bid. But I'm not sure there's a lot of value still left in. I think the Smarties have already been on this trade. Okay. Now, one thing that might happen to Woolworths post the demerger is Woolworths itself might go up. Now, its share price is going to change because you know, there's a formula for how this thing is done, and it's done for you.
There's got to be some value of this that should bring it down.
But there are. It will come down, and its cost price will come down too, and you can read all about in the article about how you adjust your capital gains tax price. But one of the things that's always held Woolworths back is that some fund managers just won't buy Woolworths because of the poker machines. Now, they're not a big part of Woolworths. They're a very significant part of the New Endeavour drinks business. And maybe Woolworths itself might get a little bit of a boost post the demerger. But look, do you buy it now? I'd probably say no, but what I have got in the article, Peter, is everything you need to know about the capital gains tax price, where I expect Endeavour to trade. I'll put a valuation on it, one of the first out there.
Yeah.
And it's an interesting company because despite it, being in a pretty low growth industry, I mean, the retail drinks business compound annual growth rates are about 3%. That's the industry, so it's not a fast growing business. But that all said, if you put the poker machines to one side, the whole Endeavour drinks business trades at has quite a higher operating margin.
That's profit, by the way.
That's profit than does the Woolworths food business. It's almost the margin's almost twice as high.
Well, you can price alcohol for drinkers very, very effectively.
Yeah, and they make pretty good money out of their pubs business.
Yeah.
Now, so you've got to get over the ESG concern about poker machines, but maybe that group, the team, its own balance sheet, actually can. And it is the biggest hotelier in Australia, as well as having the best retail drinks brands.
356?
Yeah, about 350 odd hotels. It's also, as I said, the number 1 and number 2 retail drinks brands in Dan Murphy's and BWS.
Yeah.
So about 40% market share of the retail drinks market. Biggest hotelier. If they can get the hotel business on fire, you get out of COVID, and they refurbish what their plans are, put some, it's actually got some good prospects. So I think longer term this could be interesting, but it'd be interesting to see just what the mix is of in terms of those getting out for ESG reasons, and then post the event, just how big the whole ESG issue is in terms of who can buy it and who can't.
So you're really saying that Woolworths could go up because of the goody-goody two-shoes who would like to be in there, and they wouldn't buy it when it had the drinks and the poker machine aspect to it. Then on the other hand, Endeavour drinks could go up because all the batty one-shoes out there who really love drinking and playing poker machines.
Yeah, I mean, I expect in a year's time, no doubt, that the sum of the parts will be bigger than what it's worth today, right? I think this is going to be a successful demerger.
Right.
I just think there might be a little bit of selling up front. So you may do better. You can probably be a bit patient, but look, it's a bit of a line call on this one, but I think there's a lot in our Switzer Super report that, including where we think it's going to trade, Peter.
Yeah, so if you really want to be a smart investor rather than a dumb investor, you read people like Paul, and me too as well. That's Paul Rickard from the Switzer report.